All right. Good afternoon, everyone. My name is Cassandra Taylor, and I'm the founder and CEO of Top Flight Defense Incorporated. And we are here today with Ms. Torres to discuss home ownership. So I won't get in her way. I'm going to let her go ahead and do what she does. So, Ms. Torres, take it away.
Thank you. Good evening, everyone. Today we're going to talk about home ownership and everything, all the costs, the fees, how buying a mortgage, everything that involves buying a mortgage. I'm going to share with you some offers that BMO has if you're considering to look for a mortgage. I'm going to go ahead and turn off my video and share my screen so we can begin. Are you able to see?
Yes.
Okay, perfect. Thank you. So like I said, we're gonna talk about home ownership. This workshop today, it's designed to help familiarize you with the home buying process. So you're gonna learn how to prepare for a mortgage. You're gonna be able to understand terms of a loan, review the one-time and the cost associated with buying your home, and explore different methods to help build your personal and financial readiness for home ownership. So let's go ahead and get started. So today we're going to cover some important information to help you prepare for home ownership, like how lenders are going to evaluate your loan application, steps that you can take to prepare for obtaining a loan, as well as costs that you're going to encounter on your journey towards buying your home. So we're going to explore the following. Again, the costs and responsibilities associated with home ownership, the loan and repayment process, how to find out if you're financially ready to own a home. By the time we complete this workshop, you're going to have a better understanding of how to begin working towards home ownership. Many people are unclear about the benefits and challenges associated with owning a home. So we're going to take a minute to review some of them. We're going to talk about the different pros and cons to owning a home. So it's great to own a home. It's important to understand what's involved when doing so. What are the benefits of owning your own home? Are there any negatives to owning your own home? So let's take a look at some of the pros and cons to owning your home. So when we think about it, in truth, there's no right or wrong answer. So there's both pros and cons of owning a home. Each of these statements has potential positive and negative angles. So let's take a look. So when we look at the pros and cons of, is your home an asset? The pro is the value of the home, right? It can go up over time. The con, on the other hand, is just like the value of your home can go up over time, it can also decrease over time. Another one, you need to make payments towards a home, right? The pro for that is a portion of your monthly payment goes up to the principal and it gets you closer to owning a valuable asset. The con is you need to make large down payment upfront, monthly payments, and other one-time and ongoing costs to owning your home. On the downside, buying and maintaining your home is going to cost you over the years, and making your monthly payments could be stressful at times. But ultimately, buying a home is a forced savings plan. In the end, you will own the house, and even if the value goes down, you're going to be better off than if you had remained as a renter and being a tenant. So what are the pros and cons of the idea that you need to pay taxes on a home? So homeowners are able to deduct mortgage interest and property taxes in their income tax returns. That could be a pro if you're able to do so. The con is that you have to pay property taxes, which you wouldn't be responsible if you rented your own home. So your local government's going to charge you taxes to help them pay for services they provide. But up to $10,000 of that money could be tax deductible. So if the monthly amount you spend on your housing expenses is more than you would have paid in rent, then this tax deduction might help out with balancing the scales. So the pros and cons with the idea that you can remodel your home any way you'd like. So the pro is you can renovate and decorate your home according to your likes, your taste. The con is you're responsible for the cost and repairs of remodeling your home. So owning your own home means that you're the boss. You can decide what color to paint your walls, what to do to your floors. You can remodel as many times as you'd like, but just remember you're the one who has to pay for the cost and any repairs that you may have to your home, such as a faulty faucet, a plumber needs to come, you're in charge of paying that. So that would be some of the cons to owning your own home. So knowing the pros and cons of home buying gives you a realistic approach towards home ownership. So let's talk about what you can do to prepare yourself for the process of buying your own home.
Ms. Torres, can I interrupt you right quick?
Yes.
Because someone on Facebook, they are a veteran, a disabled veteran, and depending upon what our disability rating is, we don't have to pay property taxes. So let me make that disclaimer that you're only speaking on how a civilian or someone that's not non-military would do when it comes to home ownership.
Right. Thank you.
You can continue. Thank you.
And then these are some common terms when we talk about home ownership, and we're going to go over what they mean. So most people can't afford to purchase a home without borrowing money. Typically, they're going to need to buy their home. They're going to need to obtain a loan from the bank or credit union or some other type of lender to help you pay for the purchase of your home. This is called a mortgage. To obtain a mortgage, it's important to understand what lenders are going to look for in a borrower. So let's review some of these terms. Income and income history inform a lender whether a borrower is going to be able to afford and repay a mortgage loan. Debt to income ratio is also known as DTI. It's a percentage that tells lenders how much of a person's monthly income before taxes is going to go towards paying their debt. Lenders prefer to loan money to people whose expenses are less than 43% of their monthly income. And we're going to talk about the DTI in a little bit as well. So why are some credit scores important to a lender? So a credit score reveals whether a person repays their debts on time. A very good or exceptional credit score indicates that you're likely to make your mortgage payments on time and are worthy of a loan, assuming that you also have income to pay for it. So you may qualify for more of a favorable loan term, so better rates, by having a good credit score. So why is a down payment important to lenders? So down payment is generally a lump sum of cash that you use to pay for part of your home purchase. Having enough money for a down payment shows lenders that you are committed to the purchase and that you're likely going to be able to repay a loan. Your ability to save money also shows lenders that you're capable of maintaining a safety net in case of an emergency or unforeseen circumstance. The top 3 reasons why people default on loans are family-related changes, for example, having a new baby or sudden responsibility of caring for an elder. This causes expenses to increase. An accident that requires medical attention or time off of work. This causes, right, expenses to increase and possibly your income to decrease. And then the last one is a change in job status that can cause income to decrease. Lenders prefer candidates who are low risk, meaning they're well prepared to pay their mortgages, even if their present circumstances change. So a major concern for lenders is typically, can you repay your loan? Borrowers who have a steady income, savings, and a good credit score and good DTI are typically considered low risk and more likely to pay their mortgage on time. On the other hand, a person with insufficient income, little savings, poor credit, or a high DTI is viewed as more likely to default on a loan and considered a higher risk to a lender. Being a good low-risk candidate for a loan is one of the factors that determine the amount of money you can borrow and the interest you're going to receive when you get your home. So let's take a look at how you can prepare to be a good candidate for a loan. For any type of loan, lenders, we generally use 5 criteria to determine credit worthiness. This is known as the 5 C's of credit. Knowing them can help you prepare to become a good candidate for a mortgage. The lenders use the 5 C's to determine if they should lend you money. So the first one is capacity. So capacity is your ability to pay for your bills now and in the future. If you have a steady job or a profitable business, lenders are going to trust that you're going to be able to pay your bills. Capital. So this is available money and savings, investments, properties, and other assets that you can sell fairly quickly for cash to pay back the loan. Assets are any items that have significant monetary value, right? So capital could be the home that you're actually taking a loan out for. So should you default on the loan, the bank is able to take your home, and that's generally used as capital. Same thing when you purchase your car is usually used as capital. So should you not make payments or default in payments of your card, the bank is able to take that back. So excuse me, that's collateral. It's the property in possession. Character is your history of delivering on commitments. So character, right, your credit score, your ability to pay your bills on time. So that's where your credit score ties into play. They're going to look at that. If you're making and paying your bills late, then your character, it might play a factor in you not receiving your loan. Conditions, they're the general circumstances of the borrower and the loan, such as the purpose of the loan, factors that might affect your ability to repay, and similar conditions that might impact the loan in general. So when you're thinking about, ask yourself these following questions. How could you show capacity to pay for bills now and in the future? Some things would be your employment history. You can use your current pay stubs, your earnings from a business. That's one way you can show capacity to pay your bills. Some examples of capital that you can use, again, your cash, your savings, your investments, valuables that you can liquidate quickly. So like that's why banks ask for your bank statement, for your checking account, your savings. They want to see what's in there, what types of collateral. So again, your cars, homes, land. Those are some types of things that you can use for collateral. Again, depending on the type of loan that you're looking to secure. For a home loan, we're going to use the home that you're buying as collateral. And then again, when it comes to character, establishing a good history of making and paying your bills on time is going to show good character. Some conditions that are going to positively affect how a lender views your application is showing you have enough down payment, enough saved for down payment, plus some money for reserves, or applying for a loan that's well within your means to repay. Another step toward home ownership is having an accurate picture of your current financial situation and understanding how it relates to the home you're going to buy. This step has two parts. So the first, we're going to take a look at 2 of the 5 C's, so capital and collateral, and then we're going to talk about debt to income ratio. Capital refers again to cash, savings, or any asset that you own that has a significant value. Again, like a car, your home, investments, or jewelry. These are things that you can sell quickly for cash. To determine your personal capital, you're going to list all of the items you own and then their approximate value. Knowing the value of your possessions is important because it can show lenders that you have assets with cash value that can be applied to loan payments if your income ever becomes an issue. Collateral is an asset, again, that the lender uses as security in exchanging for giving you the loan. So when you obtain a mortgage, your new home, again, is going to be used as collateral. It's going to guarantee the loan. So again, if you default or miss your mortgage payments for a long period of time, the lender could come in and take your home. If you don't have much of a credit history, lenders may feel more comfortable giving you a loan if you have collateral to secure it. People who have a limited credit history are going to find it easier to obtain a mortgage or car loan more than a personal loan where there's no collateral. So now that you have a basic understanding of some important terms and how assets play a role, we're going to talk about how you can assess if you're ready to buy a home. So we are going to look at Christina's action plan and spending plan. And then for this, I am also going to pull the participant guide so we can read the scenario. I believe. Did I just go off?
Yes, your screen is you're no longer sharing.
Okay, I'm pulling the participant guide. Are you able to see now?
Nope, can't see you.
Let's see.
Okay, there we go.
Yeah, okay. Let me turn to page 3. So looking, and then I'll add the participant guide as well in the chat. But these are some of the action steps that you can take to help meet your financial goals in various categories. So you would just put a check mark next to the steps that you already do. These are some examples. So researching the features and fees of your current account, identifying 3 ways to cut your monthly spending, make a plan to pay off credit card or other debt, identify the interest rate and fees of your current credit cards, research other options that may provide better terms. So just creating an action plan to track some of your spending is going to be able to help you prepare for home ownership. You're going to want to develop an awareness of your financial situation by making a list of your current assets and your debts. Just like the example here. Christina, she has a list of her needs, right? With some of her debts on there. And then you also see what she's spending for some of her wants. You can see that her total expenses are $1,755. And then her total expenses are $360. So this is what she used to itemize her necessities, and then this is what she used to itemize her wants. This is something that you can track and use for yourself as well. So now that we've seen what she's spending and what she's doing with her action plan, we're going to talk about ratio and more. So when it comes to debt to income ratio, capacity is one of the 5 C's of credit that comes into play. So capacity is your present and future ability to meet your payment obligation. So one of the calculations that lenders use to determine your capacity is your debt to income ratio, so your DTI. Lenders use the DTI to predict whether a borrower is going to be able to make their payments. So the DTI is calculated by dividing your total monthly debt, includes your mortgage payment, by your total monthly income. And your income is before your taxes or any deductions. Then you're going to multiply it by 100. The result is the percentage is going to be where your DTI is at. So here's an example of Marta. So looking at Marta's expenses, she has $1,700 in expenses a month. Her monthly income is $4,000. So if we were going to figure out her DTI, we're going to come up with, she's close to 43% of her monthly income. So she's actually at 42.5% of her income. So we're taking the 1,700, dividing it by 4,000 to get your DTI. And that's something you would do yourself. When you're calculating your debts as well, it's counting anything that's going to show up on your credit report. So it's not counting your utility bills. The banks aren't going to look at that information. They're going to view whatever debts that you have that are showing up in your credit report. So if you are co-signing for a car, for example, and you're not responsible for making the payment, it's showing up on there. Just depending if you can provide proof that you haven't been making payments for a specific number of times, the bank may exclude that. Otherwise, that's going to be calculated into it as well. It's because it's showing up on your credit report. So just keep in mind, any debts that show up on your credit report is what a lender's going to use when calculating your DTI, on top of the mortgage that you're taking out, what that's going to be. So to qualify for a mortgage from a financial institution, your DTI also must be lower than 43%. Borrowers with a DTI percentage that have higher than 43% may have more trouble making payments and may not be able to qualify. So since Marta is below 43, she's at 42.5, she's a good candidate for a loan. So now we talked about capacity. So you learned that your capacity or your ability to pay bills and repay loans is important to lenders. It also affects your credit score. This is another factor that can have a big impact on the type of loan you qualify for. Your credit score reflects how responsibly you've paid your bills or debts in the past. Plays a major role in your ability to obtain financing. Lenders consider your credit score when determining whether to approve a loan and how much they're going to allow you to borrow. When you're applying for a loan, your lender's going to ask you for your social so that way they can pull up your credit report. And then your report's going to show your history of debt and payments that you've made, like card payments that you've made to tax student loans, car loans, and they include also your score based on your history. So lenders, financial institutions, they're gonna use the score to assess your risk level as a borrower. A loan number, so when you're looking at your credit score, your score ranges anywhere from 300 to 850. Lower the score, the more risk you are, higher the score, or you're considered, also better rate most likely you're going to get. So a low number means that you're high risk, right? It means that you might have to pay more for a home. Maybe you might need to put more money down to be able to qualify, because depending on what the score is, lenders are going to value the rate on your home. The term also matters, but the rate on your home, and then that could reflect your ability to be able to get that home or not. So just keep that in mind. And then credit scores are determined by looking at information from the 3 major credit bureaus that we have in the U.S. It's Equifax, Experian, and TransUnion. You can always request a copy of your credit report and review it for accuracy before you go out looking for a home. You do have access to view your credit report for free once a year. And the best thing to do to improve your credit is just making sure that you're paying your bills on time. That makes 35% of your credit scores determined by paying your bills on time. So that's the most important thing, is making and paying your bills on time. Another thing is using less than 30% of your available credit every month, making sure you're not maxing out on your credit cards. That's going to help improve your score. Limit credit applications. Applying for too many cards or loans in a short amount of time could lower your credit score. So if you plan on applying for a mortgage within the next 6 to 12 months, try to avoid applying for a new credit card. So we've learned how to assess your financial situation to help you better understand how you're going to be evaluated by lenders. Now let's take a look at some of the costs associated with buying a home. So understanding other costs associated with home buying can help you be better prepared to make all your necessary payments. Commonly discussed home buying expenses are down payments, mortgage payments, real estate taxes, homeowners insurance. There's other costs that may not be well known. So these are costs that come from your title insurance, closing costs, inspection fees, appraisal costs are just a few. We're going to talk about some of these. So let's take a look at the costs associated with purchasing a home. So most buyers use a mortgage to purchase their home. So they use their own money to pay for a portion of the price of the home, and then they're going to borrow the rest from a lender. A down payment is an initial payment towards the purchase of a home, and it's usually between 3 to 20% of the purchase price. So your savings, your loan size, and credit score is going to determine the actual amount that you're going to need to put down. In general, the larger your down payment, the lower your monthly payments are going to be. And you can actually purchase a home without a large down payment because there's different grants that you can get. There's a lot of assistance for first-time home buyers, for veterans. There's many different grants. You may not need to come in with a large down payment. If you don't find any grants or any opportunities, in mind, if you're not coming in with a large down payment, your payments are going to be higher. So most people put actual money down. The more, again, you're able to put down, the lower your payments are going to be, and less you're going to be paying in interest. So financial institutions tend to recognize buyers with down payments as better prepared for buying a home and less of a risk. That's because you're investing some of your own money, so they consider that less of a risk. Doing so can lead to, if you're not making your payments on time, we talked about it earlier, right? It can be, the bank can come in and take your home. And then again, you're losing all the money that you put down for your down payment, and you're losing money that you put into the home as well. The down payment is only one of the costs associated with buying a home. Other costs you're going to also incur during, before, and after the home buying process. So it's not easy to know how much money you're going to need to save when you're preparing to buy a home. So let's explore some of the expenses that you're going to encounter during the home buying process, so that way you're prepared once you're ready to buy a home. When you buy a home, you're going to generally pay all of the costs associated with the transaction. However, depending on the contract or state law, the seller may end up paying for some of those costs. As we discussed, lenders are going to check your credit score. Buyers are usually responsible for paying a credit report fee, which can range from anywhere from $20 to $50. So your local government provides services like trash collection, recreational areas, your public schools, to pay for these, your parks. To pay for these services, the city is going to charge a tax on your property. So this is called a real estate tax or a property tax. Homeowners are responsible for the cost. And again, it all depends too on the type of home borrower you are and the type of loan that you're taking out. As explained earlier, veterans, you might not have a property tax. But if you're a regular consumer, you will have to pay property taxes for your home. It's highly recommended that you hire an independent inspector to assess home issues or maintenance needs. This is where inspection costs come into play. Hiring someone to do your inspection is going to help you should something repairs need to be done in the home. You can hire your inspector, pay the fee, and then any repairs that need to be done to the home, you can request that the seller pay for the repairs that are identified or reduce the purchase price to compensate for you. So your inspector that you hired is going to provide a detailed report of all the aspects of the house, including the quality of the roof, plumbing, appliances, gutters, heating system, and so on. An inspection fee, it's very recommended, but it's not required. So just keep that in mind. Repairs are often noted in the inspector's report, and then usually the seller's going to agree to fix any problems because you got an inspection and you've identified issues. Expect the maintenance of the home to cost you between 1% and 4% of the home value each year. You might encounter expenses like hiring yard maintenance services, making repairs as needed. You may need to update your appliances. You might also have to take on more expensive projects like replacing the roof or renovating the kitchen, which can make some years' maintenance cost higher. Appraisals, they're often requested by lenders to ensure the value of the home, that it matches the purchase price. The buyer is able to negotiate these fees and have the seller pay them. So that's something that you can request to have the seller pay is for your appraisal cost. If not, that's something you might have to pay as well. Closing costs is another upfront cost of purchasing a home. So this is a large expense to save up for. It's helpful to know the expenses, including in your closing costs. Let's take a look. Closing costs are expenses over and above the purchase price of the home. They are paid at the end of the home buying process when the deal is closing and when in many states the title of the house gets transferred from the seller to the buyer. So closing costs may include, but not limited to, appraisal fees, tax service provider fees, title insurance, government taxes, any prepaid expenses like property taxes, homeowners insurance, and interest until your first payment's due. So typically the amount of closing costs is between 2 and 5% of the purchase price. It can be more, it can be less, depending on the location and value of the home. You're not actually going to know how much the closing costs are going to be until your lender provides you with a detailed estimate of all the costs associated with the mortgage. So you can also check your state laws to learn more about the different fees and charges that you might be responsible for as a buyer. Or you can always ask a lender if they can provide you with an estimate. So now that we talked a little bit about the cost associated with the home buying process, let's take a look at insurance costs that you might need to account for. We're going to talk about private mortgage insurance, or PMI. So some mortgage options allow you to make a down payment of less than 20%. When you do that, you're going to generally have to pay private mortgage insurance, or PMI. So this requirement varies by lender. We're going to cover the basics of it. So PMI, or private mortgage insurance, is used to ensure that the lender is going to recoup the balance of the mortgage in the event that the buyer defaults on the mortgage. The cost you pay for PMI varies on the size of the down payment and then the amount of your loan. PMI protects the lender, not you, if you stop making the payment. Why would a lender require mortgage insurance? Well, because it reduces the lender's risk. PMI enables buyers to qualify for a loan that they may not normally qualify for. The cost of insurance is going to be added to your monthly mortgage payment. So PMI costs about $30 to $70 per month per 100,000 you borrow. The good news is that once you have 20% equity in your home, you can request to have your PMI canceled, which is going to reduce your monthly payment. So let's say you're borrowing a home for $100,000 and you're putting down only $5,000. Since you're taking a loan out for $95,000, which is 95% of the home's value, you're over the 80% threshold, so you're going to have to have PMI. If real estate values in your neighborhood increase and your home increases to $150,000 versus $95,000, you're going to be able to eliminate the PMI because now you're going to owe less than 80% of the home's value. The mortgage insurance discussed so far is associated with conventional loans that you may receive from a bank or a credit union. There's other types of loans available, and we're going to talk about some of them. And these are just some of the loans, not all. So typically when we think about a mortgage, we imagine a conventional loan that we get from a bank or a financial institution. There's other types of loans as well. When we think of conventional loans, these are loans offered by banks, credit unions, mortgage companies. Requirements vary depending on the lender and your credit worthiness, including your credit score and your debt to income ratio. Government-backed loans, these are loans that are guaranteed by the government agencies for buyers who may not have had a good history or may not have enough money for down payment. So this is where you FHA, your VA loans come into play. Federal Housing Administration, or FHA insured loans, these are to borrowers that have low score or limited down payment. With VA insured loans, these are loans eligible for veterans, service members, and surviving spouses. The VA can guarantee a portion of a loan from a private lender. And then there's the USDA loan. These are loans where people are looking to buy a home in a rural area. The USDA offers several types of loan assistance for direct loans and guaranteeing the loan. Although government-backed loans help people who are otherwise not able to qualify to buy a home, there's a limit of money that they can borrow. Insurance on some loans, such as those offered by the FHA, USDA, or VA, can be high. So make sure that you research the mortgage insurance that's associated with the specific type of loan when you're looking to buy your home. So now we've talked about, the home buying process. We've talked about different types of loans that you can take out. Now let's talk about price range when we're looking to buy a home. What's the price range you can afford? Lenders ultimately are going to tell you the amount that you're going to be able to qualify for, but you can still get an idea of how much you're able to afford. You can save a lot of time by looking for homes that are within your reach and your limit area. So we talked about it earlier. There's two methods that can give you a quick idea. The first is 2 to 3 times your income rule. And then the second is 28% of your monthly income. So when you're thinking of that, think about how much you can afford for a down payment. You're going to want to write that down. Then you're going to want to write down how much you earn per year. You're going to multiply your earnings then by 2. You're going to write down that number. And you're going to multiply your earnings by 3, and that's how you're going to determine and utilizing the 2 to 3 times your income rule. When you're using the 28% of your income rule, you're going to want to know and it's also going to be in your participant guide that I'll send in the attachment so you can calculate on your own time. So you're going to want to approach home buying from a knowledgeable and informed perspective. Knowing the results from how much you can afford is going to help you refine your future housing costs. It's important to remember that these are just calculations and it's just a general idea or general rule of thumb. Your situation can vary. So you can always talk to a financial expert, a lender. They can help you determine your home buying budget. So with the knowledge that you've learned today, you're going to be able to assess whether home buying is the right choice for you at this time. As you evaluate your personal and financial readiness for home ownership, know that you're not alone. There's different resources available to you that can help you plan and understand the home buying process. And then in your participant guide, you're going to see different types of free resources that you can use. There's many different resources available to help you fully understand all aspects of home ownership. If you feel confused or uncertain, you can contact one of these government agencies to help you walk through the process. So you can contact HUD, you can contact consumerfinance.gov and get information on owning the home there as well. You can always, again, also reach out to a lender. A lot of times too, realtors have information, right? They're helping you look for a home. They can always also recommend a lender, or they usually have people that they work with that can also help assist you and let you know if you're ready to buy a home or not. Always do your research before, and always talk to people before you're ready to buy a home. If you're going to a financial institution or a lender, you don't have to necessarily have them run your credit and that to get an idea if you're ready to buy. You can always have a conversation with them. If they're a good lender or a good financial institution, they'll kind of give you a guideline if you're ready to buy, if you can buy or not without actually pulling your credit. Once they pull your credit and verify that information, they'll be able to determine exactly if, but you can always get an idea. Sometimes people think, I'm not ready yet, and there's different programs, different resources available to help where you might actually be more ready than you thought to be able to buy a home. And sometimes you're not. Sometimes, you need more time, and the bank will, or lender will help you and say, okay, based on what you told me, you may need to work on X, Y, and Z to be able to buy your home. So just know that there's a lot of different resources that you can reach out for help and assistance. So just remember, it's important to understand your personal financial readiness before you're looking to buy a home, and make sure that you're checking your personal credit, looking at your DTI when you're considering buying your home, and then think of all the costs that are going to be related and that are going to be associated with buying your home before you start the process of purchasing a home. Any questions? Any questions, Cassandra, on Facebook?
I don't see, I don't see
No?
anyone asking at this moment.
I'm going to share a couple things in the chat box as well. I'm going to add them in, and I'll just share now if I can get back in here. Can't get in. Are you there, Cassandra?
Yes, I'm here.
Oh, I'm trying to get in. I can't. Okay, here we go. So
Yeah, no one is asking any questions yet.
Okay, I'm gonna share.
They're just watching, so they're looking at it as informational, so they know we'll come back and share this later.
So this is just some assistance right now that BMO, our financial institution, is giving to those looking to buy a home. So if you're looking to purchase a home, remember I talked about the different grants, different programs that you can qualify. Always look for those opportunities first, because if you have the opportunity to get free money, why not, right? Just you're researching what banks, what financial institutions, what lenders offer, and different programs that you may be able to qualify for with B. We have what's called a Welcome Home Grant, where you can receive up to $29,500 in down payment assistance for buying your home. It's not just a BMO thing. BMO is giving up to $16,000, and then we're also adding in if you qualify for the IDA program, and then another down payment assistance program to get the additional funding to equal the $29,500. But this is just one of the programs that we offer. There's other banks other lenders that offer different programs. Again, always.
Could you show that up on the screen?
Yeah. Are you able to see it?
No, ma'am.
Oh, it's still not sharing? Okay. Let's see here.
There
Can
we
you
go.
see it now? Okay.
Yes.
Yeah. So here, and I'll include this, I'll share it all in the chat. You guys have the flyer. If you are interested in finding out more information, my contact number's in there. And then Loretta, she is our community reinvestment relationship manager. So she specializes in CRA loans and grants. So if you're interested, please reach out. I'm also going to share the participant guide that we talked about earlier. So your participant guide is going to just pretty much have, you know, a checklist. Are you ready to buy your home?
Okay.
You're going to be able to create your spending plan, be able to calculate your own DTI, as well as calculate some, you know, home buying costs based on what we talked about, your affordability, using the 2 times your income or the 28%. And then the last thing that I will share that you're gonna have access to is if you're looking for a bank or looking to make changes with your banking, we have an offer that you can take advantage of for banking with BMO, where you can get up to $810 for banking with us. I'll include that as well. It'll have the QR code. If you're interested, you can always scan the QR code. 2 out of the 3 checking accounts we offer are completely fee-free. There's no minimum balance required. The same with our savings account. We have a savings account that no minimum balance, no fees required, no fees charged to you for banking with us. We're actually rewarding you to save. So there's a bonus offer that we give you if you, for every month that you put $200 or more into your savings account for the first year, we're going to add additional $5. So potentially you can get $60 just for savings. The great thing about this is if you're looking to buy a home, or we've talked about budgeting in the past, you can set up your own savings account without having to worry about putting a certain amount in there always, and not incur fees when you're trying to save your own money.
Well,
So
I noticed Top Flight is underneath the apply now. So what does that do for Top Flight?
So what it does for your members is your members get to take advantage of this offer. So typically if you were coming into a branch to open up an account, you wouldn't qualify for this offer because Cassandra is wonderful and she loves to provide financial literacy to her community members. We're able to give you guys this.
Oh, yay. Okay, thank you. Okay, so everyone is still watching. No one is asking questions. They're just taking it all in. So while they're just watching and taking it in, can we go over the class that we're working on, trying to have the budgeting class?
Yes.
So you can go ahead.
When we get to do the workshop.
I would, because we're just getting into ending July, getting into August, and our August is kind of packed. I would like to see what we can do far as a September date, getting that in there, and that's enough time to get the packets, the budget sheets out to everyone that signs up for it.
Yeah, just let me know. September, for the most part, I'm pretty open now. So you can just let me know. We're looking for a Saturday. Oh, excuse me, the September 30th, I'm not going to be in town, but other than that, any other Saturday, just let me know and we will set it up. In person, we're looking to set something up in person.
Yes. So that would work out great. I just need to make sure I have everything set up for you. And I know we already have the location, which is the BMO Harris Bank branch here in Plainfield, correct?
Correct.
Okay. Okay. Well, I'm excited and I'm glad that you have partnered with us to bring this financial initiative to our community because we need it.
And BMO is going to be offering additional services in the future for veterans, so more to come.
Oh, really?
Yes,
Okay, I can't wait.
we can't wait either.
Well, I thank you so very much for coming on and sharing your time with us and knowledge, because we definitely need it. Just when you think you know it all, something else comes up and let us know that we don't know everything.
Mm-hmm.
So I appreciate it. So what I'm going to do now, I'm going to stop the Facebook Live. No, I'm going to stop the recording. And then I'll stop the Facebook Live. So hold on.